Well, after starting the year out strong, stocks have kicked off 2024's second quarter in the red. But with a big week ahead, investors' focus shifts to Friday's jobs report. That will serve as another important signal to the Federal Reserve. For more on that and what to expect in Q2, let's welcome in Emily Roland, John Hancock Investment Management Co-Chief Investment Strategist. Emily, it's great to see you. Thanks for being here. I want to start off with a little bit of economic data that we got today and kind of frame how we should be thinking about the data then heading up into Friday's jobs report. As I mentioned, we got those PMIs today, measures of manufacturing, better than estimated, or at least expanding, but prices going up. So what does that tell us kind of about where we are and where the Fed is?
Yeah, thanks for having me, Julie. Nice to see you as well. That was a big data point this morning. ISM manufacturing now back into expansionary territory for the first time since 2022. We've been getting similar reads on things like the U.S. leading economic indicators, which jumped to positive territory last week, again, for the first time since 22. So we are seeing this modest reacceleration in the economic data, particularly, of course, on the manufacturing side. And that's causing all of us cycle-based investors to kind of extend our late cycle investment call here. We're kind of in this never-ending period where the lagged impact of Fed tightening just has not tipped us into contraction. So we think investors should be thinking about how to position for that. But of course, this backup in bond yields, 12 basis points on the 10-year, about 8 on the 2-year is really kind of shifting the narrative, and markets might not be celebrating so much anymore if it looks like the Fed's got to remain on hold.
What are your expectations for the Fed, Emily, though? When do you think they can start cutting? You know, Ed Yardeni now, I saw in a note to his clients, he's thinking his base case is still 2 cuts. But later in the year, Emily, he's seeing November and December. He also told his clients, though, listen, he wouldn't be surprised if you get no cuts this year. Well, how are you all thinking about it?
I'd say that wouldn't totally surprise us either. You know, I was hastily refreshing the CME FedWatch tool after this morning's manufacturing data, and the market is still pricing in a cut for June and 3 cuts over the course of this year. The probability of a June cut went down a little bit, but that's where the market odds right now are. And in our view, I think it's going to be tough to make the case that the Fed can start cutting in June. You've got, again, prices paid, Julie mentioned in the data this morning, elevated. You know, we'll find out how wage growth looks in the jobs report on Friday. But if inflation continues to be sticky, it's taking a while to get down to the Fed's 2% target here. We've seen progress on disinflation sort of stalling over the last few months here. We think that rate cuts may be later in the year. Now, one thing that's a little bit different than what you may be hearing is that once the Fed does start to cut, we think those cuts are going to be a lot more severe than investors anticipate. In fact, if you look back at the last 5 Fed rate cutting cycles, the Fed cuts on average 17 times. Usually there's something wrong when the Fed is cutting. So that's something that we would be thinking about as investors today.
Emily, will that finally be the thing that rattles the market? I mean, you know, we got stocks off a little bit today, right? Not really anything meaningful. And I was going to ask you what you think would be the thing that would unsettle the market in a more decided fashion. Would it be the realization that the Fed is maybe going to cut more deeply?
I think so, Julie. And what you've seen starting in the 4th quarter of last year is really this pivot party that we've been talking about, this idea that inflation's coming down. Chair Powell's been quite dovish, and you're seeing markets react positively to that idea. And as that gets challenged more and more, we think that that could create volatility across stocks. I mean, Q1, though, was pretty amazing. You saw the 10-year up about 32 basis points, oil prices up 15%, and yet the market really shrugged it off. It was pretty tough to keep up in this market in the 1st quarter without taking a ton of risk. So I think the question becomes, how much of a backup in interest rates can markets handle? And certainly if today's any indication, and again, I guess this is like the new market correction, right? I mean, it's barely anything, but we've seen almost no volatility. And I think volatility could be coming back into the forefront as we continue to see this chop in rates.
You know, Emily, selling may and go away. I think we can get ready to hear that pretty much nonstop. I'm just wondering how much weight you put on that.
Yeah, not a lot. I mean, we tend to use Fed policy, inflation dynamics, economic cycle analysis is sort of the key inputs. And, you know, obviously we've got a big election coming up this year as well. So there's probably going to be some volatility around that. Things look fine right now. Earnings are kind of just good enough. I've been saying they remind me of my 8th grade son's report card. It's like not that great, but it's certainly good enough that he's still on the lacrosse team right now. And you're seeing, again, economic growth is picking up a little bit. The concern here, though, is inflation. If we continue to see commodity prices move higher here, again, I think that could create a challenge to the inflation narrative and cause the Fed to remain on hold, which stocks probably don't love.
Wonder what the lacrosse team is in that analogy. But in any case, Emily, so what does all of this mean for strategy? I mean, something that stood out to me from your recent note is that right now you're seeing an interesting connection of momentum and quality that is probably relatively unusual. So A, what does that mean? And B, how do investors take advantage of that?
Yeah, so the momentum factor rewards stocks that have been up over the last 6 to 12 months, and it loves low volatility environments. What we have seen, and you want to be careful with momentum in isolation because it can often cause investors to get whipsawed. But right now we're seeing this marriage between momentum and quality. Quality is one of our favorite factors. It's companies with great balance sheets, tons of cash, low interest burdens, more stable earnings. So we want to be there. But frankly, the poster child for quality is mega cap tech. We still like tech, but it's pretty hard to argue that it's not overbought. The S&P 500 growth index right now is trading at a 45% premium to its long-term average. So we want to fade that in some respects and look to areas of the market that have less valuation risk. Mid-cap equities are on sale relative to their large cap counterparts. Areas like healthcare are trading cheap. And we also think energy deserves a look in portfolios amidst this pickup in economic growth, stronger demand out of China, and this kind of growth impulse that we're seeing right now permeating markets.
Interesting stuff, Emily. Always great to see you. Thank you.